When we look at the current financial landscape, it's impossible to ignore how the tension between traditional banking institutions and the world of cryptocurrencies has intensified. Bitcoin, once celebrated as a disruptive force capable of bypassing banks altogether, now finds itself in a strange and ironic situation where the very institutions it was designed to challenge appear to be influencing its trajectory more than ever. To understand whether banks are truly triggering Bitcoin's downfall, we need to step back and examine the forces at play, the motivations behind them, and the mechanisms through which this influence manifests. The conversation isn't as simple as banks hate Bitcoin or Bitcoin is unstoppable. Instead, it exists in a complex space where financial incentives, regulatory pressures, market psychology, and systemic power structures collide. Many people assume that banks act as a monolithic entity, but the reality is more nuanced. Some banks fear Bitcoin because it threatens their control over the flow of money and the profits associated with lending, custody, and transaction fees. Others see opportunity, offering Bitcoin investment products, custody services, and exposure through ETFs that are becoming increasingly popular. This duality creates an interesting paradox. On one hand, Bitcoin's ethos promotes decentralization, independence, and financial sovereignty. On the other, the more banks integrate Bitcoin into their business models, the more Bitcoin risks becoming dependent on the very system it sought to escape. The danger is that as Bitcoin becomes increasingly tied to traditional finance, it may lose some of its original purpose, becoming not a revolution, but another asset class controlled by large institutions. But to understand whether this dynamic could push Bitcoin into a so-called death spiral, we need to analyze how banks could actually exert pressure on the market. One of the primary ways is through influence on liquidity. Bitcoin's price is heavily dependent on trading volume and market confidence. Banks, especially those offering Bitcoin-backed financial instruments or holding it on balance sheets, can influence both. If a major bank decides to restrict access, halt support, or impose stricter conditions on Bitcoin-related services, it can send shockwaves through the market. These decisions might not even be intentional attacks. They can result from compliance concerns, regulatory uncertainty, or pressure from central banks. Nevertheless, the impact on Bitcoin's price and public perception can be significant. Another source of influence is the regulatory arena. Banks have long-standing relationships with regulators, and they possess the power to shape the narrative around what constitutes legitimate financial activity. A subtle shift in tone from regulators, encouraged by banks that feel threatened, can create fear, uncertainty, and doubt among investors. For example, if banking institutions push for stricter oversight of crypto exchanges or tighter anti-money laundering controls, the result can be reduced access to on-ramps and off-ramps. This restriction of liquidity is one of the most effective ways to weaken Bitcoin's market support. And if the liquidity dries up enough, prices can fall, triggering a cascade of panic selling. That's where the concept of a death spiral enters the conversation. A death spiral in the crypto context refers to a downward cycle where falling prices lead to loss of confidence, which leads to more selling, then even lower prices, until the asset struggles to recover. While Bitcoin has shown extraordinary resilience in the past, even surviving dramatic crashes, the landscape is different today. The involvement of institutional actors means that Bitcoin's fate is no longer determined solely by retail investors or miners. Large financial players, including banks, can amplify volatility simply through their participation or their withdrawal. We also need to consider the psychological aspect. Banks carry weight in the public's mind. When a major bank makes a statement warning about Bitcoin's risks, many investors listen. When a bank praises Bitcoin or invests heavily, many investors follow. This creates a dynamic where Bitcoin's narrative, once controlled by cypherpunks and tech visionaries, is now partly shaped by the very institutions that were supposed to be sidelined by the technology. Reflexively, this raises the question, is Bitcoin's downfall triggered by banks, or is Bitcoin giving banks the power to influence it by seeking mainstream legitimacy? Bitcoin's creators envisioned a system immune to centralized control, yet its pursuit of global adoption seems to have opened the door to precisely that. And this tension is at the heart of the story we're exploring. The conflict between independence and integration, between decentralization and institutional acceptance, forms the foundation of the debate surrounding Bitcoin's vulnerability to banking forces. In the next part, we'll dig deeper into how economic incentives and competitive pressures shape the behavior of banks and why some institutions may actively work against Bitcoin, while others try to harness it for profit. To understand whether banks could realistically push Bitcoin toward a downward trajectory, we need to dive deeper into the incentives that drive traditional financial institutions. Banks operate within a system built on controlled risk, predictable returns, and centralized authority. Bitcoin represents almost the exact opposite, a decentralized network, a fixed supply, and a level of transparency that challenges the opaque mechanisms traditional banks rely on. This ideological conflict is important because it explains why some banks may quietly resist Bitcoin-esque growth, while publicly appearing neutral or even supportive. Traditional banking thrives on trust, more specifically, trust that flows through institutions, not around them. Bitcoin, by design, removes the need for institutional trust and replaces it with mathematical consensus. If people can store, transfer, and grow their wealth without banks, then banks lose not only customers, but also the power that comes with controlling the financial infrastructure. This creates a natural incentive for some banks to discredit, suppress, or slow down Bitcoin's expansion. But the pushback isn't always overt. It often emerges through subtle behaviors that influence market perception. For example, a bank might release a report highlighting Bitcoin's volatility just days before a major crypto event, amplifying uncertainty. Or a bank might quietly restrict customer transfers to crypto exchanges, citing security concerns. These small actions can accumulate, shaping public opinion and affecting market dynamics. Meanwhile, other banks see massive opportunity in integrating Bitcoin into their services. Offering custody solutions or Bitcoin-backed investment products allows them to tap into the growing demand for crypto exposure without abandoning their traditional model. But this integration comes with risk for Bitcoin itself. The more intertwined Bitcoin becomes with institutional infrastructure, the more its price movements may be influenced by broader financial conditions. For example, if banks begin using Bitcoin as collateral for loans or investment instruments, then Bitcoin becomes exposed to systemic risk. A crisis in one part of the financial system could trigger forced selling of Bitcoin positions to cover losses elsewhere. This interconnectedness could contribute to downward spirals that have little to do with Bitcoin GS fundamentals and everything to do with traditional finance S fragility. This raises an important question. Is Bitcoin stronger inside or outside the traditional system? Supporters of decentralization argue that Bitcoin's resilience comes from its independence. They warn that as Bitcoin becomes more institutionalized, it risks becoming just another asset subject to the same manipulation and systemic vulnerabilities as traditional markets. The counterargument is that institutional adoption increases Bitcoin's legitimacy, stabilizes its market, and accelerates global acceptance. But acceptance comes at a price, and that price might be the loss of control over its own narrative. Banks are experts at shaping narratives. They've spent decades positioning themselves as the backbone of global finance, even during periods when their practices contributed to crises. When banks speak, governments listen, regulators respond, and investors react. Bitcoin's decentralized community, on the other hand, often struggles to present a unified message. The lack of central leadership is both a strength and a weakness. While it prevents coordinated manipulation from within, it also makes it harder to combat misinformation or push back against targeted attacks. When banks subtly influence regulatory discussions, arguing, for example, that cryptocurrencies enable illicit activity, they can sway policies in ways that restrict market access. These restrictions don't need to be outright bans. They can be gradual tightening of requirements, increased compliance burdens, or limitations on crypto services. Each additional layer of friction reduces ease of access, which can suppress demand and weaken market confidence over time. This can contribute to the kind of downward pressure that fuels a death spiral. But it's not just about regulations. Market structure plays a huge role. Banks and institutional investors have access to sophisticated financial tools, derivatives, leverage, algorithms that can influence prices at scale. In traditional markets, these tools are regulated within a framework that attempts to prevent abuse. In crypto, although oversight is increasing, there are still gaps that can be exploited through coordinated strategies or trading patterns that create artificial volatility. The more Bitcoin's price becomes tied to institutional trading behavior, the more vulnerable it becomes to these kinds of forces. That said, it's important to acknowledge that Bitcoin has survived many waves of fear, uncertainty, and manipulation attempts. Its decentralized nature gives it a resilience that traditional assets rarely have. The community is global, diverse, and highly committed, which means Bitcoin doesn't collapse simply because a few institutions push against it. However, the prospect of a death spiral becomes more plausible when multiple factors align: reduced liquidity, negative regulatory pressure, coordinated institutional withdrawal, and declining public confidence. Banks alone may not trigger Bitcoin's downfall, but their actions can contribute to an environment where negative momentum accelerates. As we move forward, the key question becomes whether Bitcoin's decentralized foundation is strong enough to withstand the increasing pressure from traditional finance, especially as more institutions enter the ecosystem, bringing both opportunities and systemic risks. In the next part, we'll explore how historical financial crises, institutional behavior patterns, and technological shifts help illuminate what might happen if banks continue tightening their influence over Bitcoin. When we look at financial history, patterns begin to emerge that help us understand how powerful institutions behave when confronted with disruptive technologies. Banks have always adapted, but their adaptation is rarely smooth or passive. When new systems arise that threaten their dominance, whether it was online banking in its early days, fintech startups, or alternative lending platforms, banks use a combination of resistance and strategic integration to maintain control. Bitcoin represents one of the most significant disruptions to ever challenge traditional financial architecture, and the response from banks follows this familiar pattern, though on a much larger scale. To understand the potential consequences for Bitcoin, it's helpful to examine how institutions reacted in previous eras. During the early days of the internet, many banks dismissed digital finance as a fad. As online banking gained traction, they shifted from dismissal to co-optation, eventually integrating it into their own systems while marginalizing smaller competitors. The same dynamic occurred with fintech innovations, such as peer-to-peer lending. Initially, banks pushed for tighter regulations on these platforms, arguing that they posed risks to consumers. Only after regulatory pressure constrained many startups did banks begin offering similar services themselves. This pattern of resist then adopt is important because it reveals the underlying incentive. Banks work to ensure that any innovation becomes dependent on their infrastructure. Applied to Bitcoin, this suggests that banks may not want to destroy it outright. They may want to tame it. But the act of taming Bitcoin could be exactly what places it in danger. Once traditional institutions are deeply involved, Bitcoin's price becomes more sensitive to external shocks in the broader financial system. Consider how traditional markets reacted during major crises like the 2008 financial collapse or the 2020 pandemic crash. Asset classes across the board fell in unison because institutional players sold a wide variety of assets simultaneously to cover losses. If Bitcoin becomes widely integrated into institutional portfolios, it could face similar pressures. A market downturn unrelated to crypto could trigger mass liquidations of Bitcoin positions, creating rapid downward momentum. The reflexive part of this equation comes from public psychology. As Bitcoin increasingly becomes associated with traditional finance, its identity shifts. Instead of being viewed as a revolutionary alternative, it becomes just another investment asset. This shift in identity affects investor behavior. People who enter the market for ideological reasons tend to hold through volatility because they believe in Bitcoin's long-term vision. But institutional investors are not ideological. They are pragmatic and sometimes ruthless. If macroeconomic conditions turn unfavorable or banks face liquidity concerns, Bitcoin could be sold off quickly and aggressively. This type of selling can trigger cascading liquidations, especially in a market where leverage is widely used. Over-leveraged positions can create a chain reaction as margin calls force traders to sell into a falling market, amplifying the decline. This is one of the most dangerous ingredients in a potential death spiral. Regulatory pressure adds another layer. When banks work with regulators to tighten compliance around Bitcoin, it doesn't necessarily kill the technology, but it slows adoption. This slowdown can influence price action by reducing inflows. If fewer new investors can easily enter the market, Bitcoin becomes more dependent on existing holders and institutional sentiment. That dependence creates fragility. If sentiment sours, there aren't enough new participants to counteract selling pressure. This dynamic has been observed in smaller crypto ecosystems, where liquidity dries up and prices fall rapidly. While Bitcoin is far more robust, the underlying principle still applies. Reduced access creates vulnerability. But beyond the economic mechanics, there's a deeper question. What does Bitcoin become if it is shaped by banks? If its price is influenced by institutional narratives, regulatory agendas, and traditional financial cycles, does it still function as a decentralized alternative? This philosophical tension is at the heart of Bitcoin's current identity crisis. Many early adopters argue that institutional involvement is corrupting Bitcoin's purpose. Others believe it's a necessary step toward global adoption. The truth may lie somewhere in the middle, but the risks associated with institutional influence cannot be ignored. The irony is striking. The more Bitcoin tries to integrate into the mainstream, the more it invites the vulnerabilities and power structures of the very system it sought to replace. And that contradiction plays directly into the question of whether banks could push Bitcoin into a downward spiral, not by attacking it directly, but by reshaping its environment in a way that undermines its resilience. Yet it's also important to recognize that Bitcoin has unique strengths. Its decentralized network remains robust, its supply remains fixed, and its global community continues to advocate fiercely for its independence. These strengths give Bitcoin a foundation that is far harder to dismantle than traditional assets. In the next part, we'll examine the potential scenarios for Bitcoin's future, including both the dangers and the opportunities, and how its decentralized nature could act as a counterweight to institutional pressure. As we consider the future of Bitcoin under increasing institutional pressure, it becomes essential to explore the potential scenarios that could unfold if banks continue to exert influence, whether intentionally or simply as a byproduct of their growing involvement. One of the most discussed scenarios is gradual centralization, where Bitcoin becomes so intertwined with traditional finance that its market behavior starts to mirror the patterns of legacy systems. In this scenario, large custodians, ETF issuers, and banks end up holding significant portions of circulating Bitcoin, effectively gaining soft power over the asset. While this doesn't grant them control over the blockchain or its rules, it gives them influence over liquidity, market sentiment, and accessibility. If most people only experience Bitcoin through custodial services offered by major banks, the decentralized ethos fades in practice even if it remains intact in theory. This type of soft centralization could make Bitcoin more vulnerable during financial crises. For instance, if a major bank holding a large Bitcoin position experiences liquidity issues, it might be forced to liquidate assets to stabilize its balance sheet. These kinds of forced sales can trigger rapid price declines, especially if other institutions follow suit. A coordinated withdrawal is unlikely, but simultaneous stress across the system can create a domino effect. This is how traditional markets behave during turmoil, and once Bitcoin is part of that machinery, it's not immune to those dynamics. A second scenario involves regulatory tightening driven by banks lobbying for stricter oversight. This doesn't mean banning Bitcoin, but rather implementing layers of compliance that make interacting with it increasingly complicated. The intended justification is consumer protection or anti-money laundering efforts, but the outcome is often reduced access for everyday users. If regulators impose heavy restrictions on exchanges or on-ramps, fewer new participants can enter the ecosystem. Over time, this can stifle growth and put downward pressure on price. Reduced liquidity increases the risk of sharp drops during periods of fear or uncertainty, feeding into the reflexive cycle that creates death spiral conditions. However, there is also a more optimistic scenario, one where Bitcoin ES decentralized architecture acts as a counterweight to institutional pressure. The Bitcoin network does not rely on banks to function. Its nodes, miners, and users form a global web of independent participants who can operate without permission. Even if banks attempt to influence the market, they cannot alter Bitcoin's core rules. This structural resilience is one of Bitcoin's defining strengths. Historically, decentralized systems tend to be more adaptable and resistant to concentrated attacks. Bitcoin's open source nature ensures that no single institution can dictate its fate. If institutional pressure becomes too heavy, users always have the option to withdraw their coins from custodial services and rely on self-custody. This possibility alone limits how much control banks can exert. Still, this resilience only matters if users understand and embrace it. If the majority of Bitcoin holders become accustomed to convenience over sovereignty, the ecosystem becomes susceptible to the same weaknesses found in traditional markets. The technology allows for independence, but the culture around it determines whether that independence is fully realized. This cultural tension mirrors a larger societal debate about financial autonomy versus institutional convenience. Another possible future is one where Bitcoin's role shifts entirely. Instead of serving as a mainstream alternative to traditional money, it could become a form of digital gold, primarily a long-term store of value rather than a medium of exchange. In this scenario, banks play both a supportive and disruptive role. On one hand, they offer secure custody solutions that attract institutional capital. On the other, their influence on price movements increases, making Bitcoin more vulnerable to the boom and bust cycles that characterize traditional assets. Whether this shift strengthens or weakens Bitcoin depends on your perspective. Some argue that Bitcoin's value proposition as digital gold is strong enough to withstand institutional volatility. Others believe that losing its function as a decentralized currency undermines its core purpose. But perhaps the most important scenario to consider is one where Bitcoin continues to evolve alongside traditional finance, rather than being consumed by it. In this hybrid future, institutions participate in the market, but users maintain strong education around self-custody. Developers continue innovating, and miners operate globally without centralized control. This balance creates an environment where institutions can influence the price but cannot destroy or fundamentally reshape Bitcoin. Whether banks trigger Bitcoin's downfall or unintentionally strengthen it depends on how the ecosystem responds. A death spiral is not inevitable, but it becomes more plausible when the community becomes complacent, when regulators overreach, or when institutional players dominate the narrative. Bitcoin's future hinges on maintaining a careful balance between adoption and independence. As we move toward the next part, we'll explore what must happen for Bitcoin to remain resilient, the role of education and decentralization, and how users can help protect the technology from the very systems it was designed to disrupt. For Bitcoin to remain resilient in the face of institutional pressure, the community must reinforce the very principles that made the technology revolutionary in the first place. Decentralization, transparency, and user sovereignty are not just philosophical ideas. They are practical tools that help protect Bitcoin from external forces, including banks that might unintentionally or strategically push it toward instability. One of the most significant factors in maintaining this resilience is education. Many users enter the Bitcoin ecosystem without understanding how custody works. how decentralization protects their assets, or why relying solely on institutional services can create vulnerability. When people treat Bitcoin like a traditional investment product, stored by a third party, accessed only through regulated platforms, they expose themselves to the same risks that exist in legacy finance. Encouraging users to adopt self-custody is essential, not because institutions should be distrusted by default, but because Bitcoin's strength lies in its permissionless nature. If a critical mass of users practices self-custody, then no single institution, or even several institutions acting together, can significantly restrict access or manipulate liquidity. Each user who withdraws their coins from custodial services strengthens the network's independence. Another crucial factor is the global distribution of miners and nodes. Bitcoin's network remains strong because it does not rely on any one country, company, or entity. If mining were to become overly concentrated, it could increase the risk of coordinated influence or regulatory capture. Fortunately, mining continues to be globally dispersed, and the incentives built into the network encourage miners to act in ways that preserve the system's integrity. However, vigilance is necessary. If banks or large institutions begin acquiring mining operations, it could introduce new forms of centralization that undermine the network's neutrality. Transparency is another pillar that differentiates Bitcoin from traditional finance. Banks operate behind closed doors, using complex financial instruments that few people fully understand. Bitcoin's blockchain, on the other hand, offers a level of openness that prevents many of the hidden risks associated with legacy systems. This transparency discourages corruption, reduces the likelihood of systemic deception, and gives users direct visibility into the state of the network. As banks enter the Bitcoin ecosystem, the challenge becomes ensuring that their influence does not introduce opaque practices or hidden leverage that could destabilize the market. For Bitcoin to avoid being pulled into a death spiral triggered by institutional behavior, it must remain grounded in open source principles and community-driven development. Developers play a vital role in protecting Bitcoin's integrity. Any attempt by institutions to push for changes that favor centralized control, such as increasing block size beyond what the network can handle, or altering aspects of the consensus mechanism, must be met with critical resistance. The decentralized nature of Bitcoin's development process makes it difficult for any single entity to override community consensus, but that protection only works if the community stays engaged and informed. Another dimension to consider is the broader economic environment. Bitcoin's behavior does not exist in isolation. When global economic conditions are unstable, such as high inflation, rising interest rates, or fiscal uncertainty, Bitcoin can either thrive or struggle depending on investor psychology. Institutions often react to macroeconomic stress by selling off a variety of assets to restore liquidity, and if Bitcoin is among their holdings, it can be affected even if the underlying technology remains strong. This reflexive connection between traditional markets and Bitcoin becomes more pronounced as institutional adoption increases. For Bitcoin to withstand this, long-term holders need to form the backbone of the ecosystem, providing stability when institutional sentiment fluctuates. These long-term holders, driven by conviction rather than short-term profitability, serve as a counterbalance to institutional volatility. The more distributed and committed the global user base becomes, the less influence banks can exert over price movements. Ultimately, Bitcoin's future depends on striking a delicate balance between integration and independence. Banks will continue to participate in the ecosystem, and their involvement will bring both benefits and risks. Their influence can amplify volatility, shape narratives, and contribute to market cycles that mirror traditional finance. But Bitcoin's decentralized foundation gives it a unique capacity to resist centralized control. Whether banks trigger Bitcoin, a Warrior-esque downfall, or inadvertently strengthen its resilience, depends largely on the choices made by its users, developers, and global community. As long as people continue to value autonomy, financial sovereignty, and transparency, Bitcoin will maintain its ability to withstand external pressure. And even if institutions create moments of instability, the network's architecture and community-driven ethos provide a path forward. If you've enjoyed this deep exploration into the relationship between Bitcoin and traditional banking, make sure to keep watching the recommended videos that dive even further into the evolution of digital finance. And don't forget to subscribe to the channel so you never miss new content that helps you stay ahead of the curve.